On August 5th, 2024, the Nikkei dropped 12.4% in a single day, the worst point drop in its history. That same morning, Wall Street triggered one of the biggest tech stock sell-offs in history, wiping nearly $1 trillion of value from the market in a matter of hours. And yet, nothing had changed in American tech. No earnings miss, no regulatory shock, no recession. So, what happened? Japan's central bank raised interest rates by a mere 0.25%, just a quarter. But in a highly leveraged financial system, that tiny fraction of a percent was a spark. It triggered the rapid collapse of a massive $500 billion trade, shaking every major market on Earth and forcing liquidation on Wall Street. Instead, the turbulence exposed a deeper structural vulnerability in modern finance, the hidden pipeline connecting a negative interest rate policy in Tokyo directly to the valuation of Silicon Valley. To understand how one small move in Tokyo forced investors to sell stocks in New York, we need to follow the money. For over 2 decades, Japan existed in an economic anomaly. As we broke down in our previous analysis of the Plaza Accord, the structural fallout from that single historic agreement cemented a multi-decade deflationary trap. To combat this persistent domestic stagnation, the Bank of Japan pinned interest rates to zero and eventually into negative territory. But money is global. It flows towards yield. So let's follow the money. Imagine a global investment fund searching for returns. In Japan, it can borrow yen at an interest rate of just 0.1%, almost for free. It then converts those yen into US dollars through the foreign exchange market. And with those dollars, it buys an asset that actually pays, perhaps a US Treasury bond, yielding 4.5%, or higher risk assets, such as American tech stocks. Borrow at 0.1%, earn 4.5%. The difference between these two is the spread, or my profit. And when a trade is executed with billions of borrowed dollars, even a seemingly modest spread can generate enormous returns. What looked like a small difference between two interest rates became a global source of cheap leverage. For years, that leverage flowed into financial markets around the world, into US treasuries, into European corporate debt, and also into Silicon Valley's tech stocks. The yen had effectively become the funding currency of the world. Institutional estimates from UBS and the BIS place the direct size of the trade somewhere between $250 and $500 billion, but that headline number captured only the visible core. Around it sat a much larger web of related positions, currency hedges, derivatives, and leverage exposures, all built on the same assumption that the yen would stay weak and Japanese funding would stay cheap. On the surface, it looked like an elegant, low-risk trade. But a yen carry trade is not one bet. It is two distinct bets disguised as one. The first is a trade everyone sees, borrowing at a low interest rate and investing at a higher one. The second is the currency risk everyone forgets. Investors earn the spread only as long as the yen remains weak, and that currency risk acts as a structural tripwire. If the yen strengthens, the yen value of those foreign assets falls, while the borrowed yen becomes more expensive to repay. For highly leveraged funds, even a relatively small currency move can erase the expected return, reduce the value of their collateral, and trigger margin calls. Investors are then forced to post additional cash or sell their holdings, buy back yen, and repay their loans before the losses grow even larger. To understand why a sudden move in the currency triggers such a chaos, you have to look at where the trap is actually hidden. The carry trade doesn't just profit from the spread, it actively creates the conditions that make the spread bigger. The dangerous part is that the trade feeds on itself. When billions of yen are borrowed and systematically sold on the foreign exchange market to buy dollars, that very action depresses the value of the yen. This creates a powerful reinforcing feedback loop. As the yen weakens, the nominal value of the investor's original yen-denominated debt shrinks when measured in dollars. The trade becomes more profitable simply because the currency is moving in the investor's favor, enticing even more participants to enter the market. For years, this mechanism helped suppress the yen and support global asset prices. But this loop has a mirror image. When the Bank of Japan shifted its target to 0.25% in July 2024, the move coincided with weak US labor data and growing fears of a US recession. The gap between borrowing cheaply in Japan and earning more abroad started to look less safe. Suddenly, the red loop activated. As the yen began to rapidly strengthen, the cost of servicing those highly leveraged yen loans rose instantly. To mitigate currency losses, investors had to buy back yen to repay their lenders. But to buy yen, they first had to liquidate their global assets. The mechanics inverted. A stronger yen forced asset sales, and those sales required buying more yen, driving the currency even higher. The exit door immediately became congested. This mechanical inversion explains the systematic panic of August 2024, when global hedge funds faced massive margin calls due to the strengthening yen. They were forced to liquidate their most liquid, profitable assets overseas to raise cash. They did not dump tech equities because their long-term view on artificial intelligence or corporate earnings had changed. They sold them because they desperately needed yen to close out their short positions. Panic eventually faded, helped by calmer central bank communication, thin summer liquidity, and a rapid repricing of global interest rate expectations. However, the underlying structural vulnerability hasn't vanished, which brings us to today. The world that made the carry trade effortless is gone. As the Bank of Japan continues its slow, historic march towards normalization and Western central banks pivot towards rate cuts, the macro spread is fundamentally narrowing. Entering a yen carry trade now is a high stakes game of chicken with foreign exchange volatility. Central banks are trapped in a delicate balancing act. Tokyo must normalize to protect its currency, but moving too fast risks triggering a structural unwind of the trillions in legacy Japanese capital still parked overseas. The lesson is not that Japan crashed the market. The lesson is that global markets had built a fragile structure on the assumption that Japan would never really normalize. The yen carry trade is a stark reminder that in modern macro finance, equity prices, central bank targets, and currency markets are interconnected through invisible pipelines. And when the pressure inside those pipelines shifts by even a fraction of a percent, the rest of the world trembles. But to truly understand how the structural trap was engineered from the very beginning, you have to look at the exact moment the historical blueprint was signed, to see how a single hotel room agreement sets this multi-decade cycle in motion. Watch my full breakdown of the Plaza Accord right here. If you have enjoyed the video, feel free to like and subscribe for more content in the future. Cheers.